Hey everybody, welcome back. It is Friday here at 12:30 p.m. Central Time, and we had a USDA report out about an hour and a half ago. I figured I would very quickly run through the numbers in the report and kind of give you a brief summary as to what the government told us about the corn, soybean, and wheat crops and supply and demand situation here today. I'm going to get right into it here. We're going to go to this corn balance sheet is where we're going to start. And you can see I've got up on my screen here already the ending stocks versus stocks to use ratio. That's actually an old chart, but in any case, I'm going to run by this stuff kind of just straight down the balance sheet. One of the surprises for some people perhaps is that USDA cut its acreage numbers for corn. We went from 92 million planted down to 91 million planted in this report, and harvested acreage went down by the exact same amount. It went down by 1 million from 83.5 last month down to 82.5. So the acreage numbers, believe it or not, were actually your surprise on the production side here. It was not the yield number. The yield number dropped, but barely. USDA took the yield from 178.5 down to 178.4 this month. So your corn yield number actually came in above expectations. It was the harvested acreage number that was responsible for the lower than expected production number. Total corn production, the estimate 14.722 billion bushels. That's down from 14.9 last month. It was below the average trade guess by about 80 million. So just on the production side, I'd say, this was a little bit friendly. The overall production number about 80 million bushels below the average trade guess. So it's friendly, but not a super bullish number in itself. Now, when you start to look at the demand numbers for corn here, USDA lowered their expectation for the feed and residual category. And this is the new crop balance sheet I'm talking about. We're not talking about old crop numbers here, new crop numbers. They lowered the feed number by 50 million. They lowered ethanol by 50 million, and they left exports unchanged. So at the end of the day, we saw the use number reduced by 100 million. So we actually lost 100 million bushels worth of corn demand on paper in this report. You've also got to keep in mind that we're dealing with a lighter beginning stocks number. And we knew that coming into this report because we had a lighter September 1st stocks number. So grand scheme of things here, USDA is estimating the corn carryout on August 31st of next year at 2.167 billion bushels. That is down sharply, but down sharply from the 2.5 billion projected last month. But that number, that 2.167, was actually above expectations by about 50 million. Now, this is where this chart that I have on my screen here, and if you're listening on the podcast, I'll explain this the best that I can. This is where this chart comes into play. The number that I really like to pay attention to when it comes to measuring a supply and demand situation would be the stocks to use ratio. The ending stocks number is just an arbitrary number. It doesn't mean anything in itself. What you've got to do is take the ending stocks number and then see how it compares with the usage. And that's what the stocks to use ratio is. So in this report today on paper for the new crop marketing year, USDA is telling us that the stocks to use ratio for corn for new crop will be 14.8%. 14.8% is very much within the range that we have been in over the last 4 or 5 years. We've been in a range of kind of like 14 up to 17 or so ballpark. So there's nothing extraordinarily shocking here or extraordinarily bullish about a 14.8% stocks to use ratio for the United States. There really isn't. And there's nothing really overly bullish about a 2.16 billion bushel carryout. The market's acting really well. The fact that we're trading 7 cents higher here in these nearby corn contracts and that the market is bull spreading on these numbers is a very good action, in my opinion, given these numbers. I'm not going to get too much into the reasoning for the market strength here. That's a whole different conversation. But the report in itself, I wouldn't say it was overly bullish, not on the U.S. side at least, and a 14.8% stocks to use ratio. Certainly not super bullish either. Let's go straight to soybeans. And this is where we had a little bit more excitement here. This is where I'd say we've got some friendlier stuff going on. We'll start off again on the top line. Area planted here for the United States. It was chopped just like it was in corn. We went from 83.8 planted acres million, down to 83.1. So they cut planted acreage by 700,000, did the exact same thing to harvested acreage. We went from 83 even down to 82.3. The yield number left totally unchanged, 51.9 bushels per acre. So your production number in beans, 4.268 billion. That was below the average trade guess by about 14 million bushels. So a little bit friendly, and not because of the yield number, again, because of the acreage numbers. Some of the demand stuff here is very friendly. USDA increased their projection for exports to 2.2 billion bushels. That's a 75 million bushel increase from just last month. And we know that export sales have been phenomenal. They're the best on record. Sales both to China and to all destinations are the best on record this year. So that's a big part of what was friendly about this report. USDA left the crush number, which is essentially the other half of your demand base, unchanged at 2.18, but that still represents, if realized, it would be the best crush number ever, I believe. So total soybean demand expected to be the best ever at 4.516 billion. Ending stocks all the way down to 290 million bushels from 460 last month. That's a tremendous decline. That 290 million bushels that's a good 80 million bushels below the average trade guess, or pretty close to it. So that's the big friendly number in this report, is this new crop ending stocks projection for soybeans of 290 million bushels. Now, like I did with corn, I will do the same thing here in the beans. I'll try to pull up this this ending stocks and stocks to usage chart. So again, this one that I have on the screen here is only accurate as of last month. Given that 290 million bushel carryout projection, it takes your stocks to use ratio on paper down to 6.4%. We have not been at 6.4% or a number in that neighborhood since 2015 or 2016. Those 2 years, we were between 5 and 7.5% basically. So we're kind of back down into that neighborhood, that 2015, 2016 neighborhood. In that time frame, the bean market traded in the 9s, it traded in the 10s, it traded in the 11s, it even traded as high as, I believe, just north of $12 at one point in 2016. So given a 6.4% stocks to use ratio on paper, I'm not going to say that 1070 for no beans is undervalued. As a matter of fact, I'd say that we're well within the range of price expectations, given or based on the last time we were here. The last time we had this kind of stocks to use ratio, we were trading prices in this neighborhood. Does that mean we have to stay here, or that we're going to trade that exact same range? No, but it's probably a decent indicator, and it tells me that this rally fundamentally is certainly warranted if these numbers are accurate, and there could even be some additional upside here. In the same breath, you could say that, you know, the market could break $1 and still be in the same kind of range of prices that we saw the last time the stocks to use ratio was this low. So some big news in the bean market here. Certainly a very friendly looking report on paper. Very strong demand projections, a lighter production number, lighter September 1st stocks. We knew just like corn that was coming, and that 6.4% stocks to use ratio. Certainly kind of a friendly deal here, grand scheme of things. To go to the wheat, USDA did make a few adjustments here. Let me see if I can get my wheat chart up on the screen. So we want wheat stocks to use ratio. So you can see that in based on this chart I've got on the screen here, the numbers are coming down. I mean, our stocks to use ratio has been coming down over the last several years, but it's still extraordinarily high. What the government did on the wheat numbers here, acreage left unchanged, and I'm just talking all wheat. I'm not going to get down into breaking it down into classes. They did cut the yield number by 0.4. We went from 50.1 down to 49.7. Beginning stocks were lower again. This dates back to that September 30th report. And other than that, you didn't really see any changes here. So in the wheat, for all wheat, you've got a stocks to use ratio rather of 42%, which is just crazy high, but lower than what we've seen the last few years. So I guess maybe there's something to that. The wheat market is trading at some very high levels relative to what we've seen the last several years. A carry out of 883 million bushels expected for the U.S. That's down from 925 last month, but still, again, a pretty burdensome number. So to recap here, and I'm not going to get into the world numbers. I wanted to just do a quick recap of the U.S. numbers. I mean, this was without a doubt a friendly number for the beans. There's nobody who's going to argue that. The real strong export projection, certainly a positive. The lower crop, certainly a positive. And again, that stocks to use ratio, when you're talking a 6.5% or 6.4% stocks to use ratio for U.S. beans, that's a much friendlier scenario than what we've seen in each of the last couple of years. In the corn, I just don't think the report was that friendly. I mean, the ending stocks number for the U.S. was above expectations. We've still got a stocks to use ratio in corn being projected. Again, that is very similar to what we've seen the last 4 or 5 years, which probably means that we may very well stay in that same price range. And what is that price range the last 4 or 5 years in corn? The middle grounds, about 370 or 380. The extreme upper ends, $4.50. The extreme lower ends, 3 up to about 320. So based on these numbers, you could very well see a trade that kind of stays within that range, I suppose. So the soybeans, the big surprise item here, and it was very friendly. And I kind of thought going into this, I thought you're going to need a really friendly report to sustain this rally in beans, and that's what we got, was a real friendly report. If you have any questions, leave comments on the YouTube video. You can leave comments on the Facebook Live video. This is the first Facebook Live video I've done with this. You can send me an email to info@standardgrain.com. I know I ran through this quickly, but I will answer any questions that you may have. Remember, as always, if you need some help with your grain marketing, go to standardgrain.com. Click on Grain Marketing Plan. Check out that subscription service. If you want to know exactly when, how, and specifically I am pricing these crops, corn, soybeans, and wheat throughout the year, it's broken down by crop year and percentage. Check out that subscription service. It's $49 a month. You can cancel it at any time. There's no obligation. Everyone have a great weekend. I hope this was useful to you. We'll talk to you next week.